Hello and welcome to this week's Market Outlook webinar with me, David Jones, and Aondo Markets. If you're watching the recorded version of this, it's held live on Wednesday, the 22nd of November at 12:30 in the afternoon. So this is a webinar we do every week on a Wednesday lunchtime. Let's just get the risk warning up. And it runs for about half an hour. And it splits down into two parts. So we'll take a look at the markets, so the major stuff, euro, pound, anything else that's interesting in FX. Indices, S&P, FTSE, DAX, we'll take a look at those. And also commodities, gold and oil, we normally wrap things up with. But also as part of today, as part of this every week, we do a different thing on sort of strategy and education. So we might look at oscillators, chart patterns, risk, all that sort of stuff. This week we're looking at price action, trading using price action. That's a pretty, it's always a bit of a loose description, I think, price action. It's one of these things that sort of comes in and out of vogue. And you could say lots of things with price action. If you trade using a trend, you're trading using price action. But we'll explore a little bit of this idea of trading just using the price as we go through to today. So that's it. And I just realized I paused my screen so nobody could actually see the risk warning. So I'll just flatten that up just for 20 seconds or so. It's a bit of an odd week this week for a couple of reasons. First of all, the main event of the week on the economic calendar is tonight, and that's the minutes from the latest Federal Reserve meeting. So the last US central bank meeting on interest rates. Those minutes get released tonight in the evening UK time. So a little bit sort of treading water, I think markets have been for the last couple of days, just waiting to see what they look like, but they can often inject a fair bit of volatility. Then of course tomorrow is Thanksgiving in the US, so the US markets are shut and they're open again on Friday, but only open for a half day. So again, I think the potential for a pretty quiet end to the week, so it's a little bit of an odd one. But let's get started. So what we use Aondo's trading platform, Trade Hub. So I think Aondo are maybe better known for copy trading, following other traders, and I do a webinar a couple of times a month on that. But you can also trade for yourself. If you have an account where you're following other traders like I do, you can also have an account attached to that where you do the normal buy and sell decisions yourself. So that's what we're using today. Those are the charts that we're looking at. So to find out more, go to the Aondo website. But I wasn't sure what to start with this week, so I thought, well, let's start with euro dollar, because we had a bit of a move last week in euro dollar. I think it's been something of a confusing picture for euro dollar, because we'd had this trend in place since April. It looks like that, and that broke during September. But just because a trend breaks doesn't mean the market's going to fall off a cliff. You know, maybe we'll see the market continue the trend, but at something of a slower rate. So the big levels, I think, that we had been watching, you know, are these sort of that's the wrong level I picked up on there. I wanted the horizontal high and low. So these old lows from back there, and the old low from sort of back here as well. And I thought, well, we'll see the market maybe sell off after the break, but expecting these lows to hold. And it did a half-decent job for about a month. Then last month, later in October, we saw the market slip below sort of 116, let's say, was the level for euro dollar, rally and push below it again. So if I'd have been looking at it, and I was looking at it here, you're seeing the market break again below that low. You'd expect, okay, well, this is it. We've had two breaks now. Away we go. But it has so far turned out to be something of a false break. You know, we've seen the euro rally something like almost 300 points, I suppose, off that new low. So I think it is a little bit confusing for euro dollar at the moment. But let's just remove that and remove that just to tidy things up. But I think it's interesting up here. If we flip it over to an hourly chart, it's a little bit euro dollar sort of stuck in, I suppose, no man's land. We have the old highs from up here left from October, just ahead of 119. So 118.80 looks to be the high, and we have the level left from back here. So this whole band, you know, that did stop the rally, and we're just about sort of in the middle. So it's a difficult one to call from here. I would be tempted, you know, if we did see a rally by euro dollar back up to these highs, up to the high 118s, look to sell short. And if we saw weakness back towards the low 116s, look to buy, assuming this was a false break and the levels are going to hold. But I think to try and be any cleverer than that at the moment, I think we need one of these levels to break. We either need a breakthrough 119, which would suggest this trend is okay and we're going back to 121, or a break below these old lows at 115.50, which then I do think finally will kick off the downtrend. But at the moment, we're a little bit stuck in the middle, so I don't think there's exactly a load of opportunities jumping out there for euro dollar. I suppose if you really had to trade it, and I wouldn't trade it this afternoon ahead of this thingamajiggy tonight, the minutes tonight. If you really had to trade it, you know, one trade could be, you know, the last couple of days it dibbled down to 117.23. It broke below it a bit yesterday, but no follow through. So we could, you know, you could, if you thought, well, actually, this is another little false break again down here on the short-term chart, be a buyer with a stop loss. Maybe the other side of 117 is maybe a trade. I think if someone put a gun to my head, I think that is probably the only euro dollar trades I could see at the moment, I think. But maybe tonight when these minutes come out and we get a bit of maybe we'll get a jerk of volatility, maybe that'll make things a little bit clearer. But it's been an interesting couple of weeks, just a little bit boring over the last week. Unfortunately, I think it's the same for the pound, really. If we let's take a look at the pound US dollar, just to remind ourselves sort of where we are in the great scheme of things. Oh, this is a weekly chart. Maybe let's make it a daily. That recovery that's been in place all year is still intact. So for me, sort of medium term, I'd still be bullish pound US dollar. The trend, I'm sort of back here, I suppose. There we go, looking something like that. We've had a little fiddle through that trend line. That trend is still up, and that's going back to March, although actually arguably the low was back in January. So we're nearly 12 months into this recovery for pound US dollar. So again, if I was a betting man, my money would be on the market rallying 400 points from here back up to 136 rather than dropping 400 points to 128. And we've seen what a good job that 130 level pound US dollar has done. Let's just take it out. Here we go. This is an hourly chart now. So this is going back to the beginning of October, so about 7 weeks or so. You know, we've seen some really odd moves. I mean, it's trading where it was nearly a month ago, well, more than a month ago. You know, so we've seen maybe plenty of volatility day to day, but not much in the way of progress. You know, so if it got slammed back down towards the 130s, it looks like a buying opportunity. But like the euro, it's got some definite problems. You know, on the upside, you know, the immediate obstacle, sort of 133.30, about 90 points higher than where we are now. So it's a bit of a little bit of a mixed picture. We did have, you know, a good trend in place. You know, again, maybe in the really, really short term, I'd be tempted to be more of a buyer than a seller of pound against the dollar, because we do have our little trend sort of chugging away up there. And I suppose, again, the aggressive trades, if you really had to trade it, be a buyer now, 132.45 with the stop loss underneath that low from yesterday. But again, I think until we get this thing out of the way this evening, the minutes, I wouldn't do much. I don't really expect much in the way of drama this afternoon from this one. Let's have a quick look at euro sterling while we're talking about this, and then actually we'll have a look at dollar yen, because that's got interesting again. So euro sterling, so the euro against the pound. Let's just see if there's a bit more excitement going on here when we take the dollar out of the equation. So euro against the pound. I think it's interesting. It's interesting. I think we talked about this last week. What a good job this big level continues to do. You know, the big level of 87.5 has stopped any weakness for the best part of 5 months now. You know, even when it dropped 600 points from those highs in August, you know, we've seen the market turn around. So, you know, I think for the longer term trader, if you thought the euro was going to clobber the pounds and we were going to have another run back up to 93, it's an interesting level down here anyway, because it's pulled back again, stop loss underneath that low. So if we were a buyer down here at 88.70, we've got a stop loss. Let's say we put a stop loss at 80. Let's say we put a 200-point stop loss on it. Let's go crazy. 200-point stop loss. So stop loss down here. And we've got maybe 500 points upside from here, but it is a little bit trapped in this sideways range. But I do think if we saw it weaken much from here, the level to watch, I think, would be this whole sort of 87.50 area again, because it's done such a good job. What had been boring for a little bit, but has woken up, is dollar yen. Dollar yen's been interesting because. And again, I'm going back to big levels. Let me maybe put some squiggles on here, because I know some people like the squiggles. So let's put the that on RSI. So we'll put an RSI on the bottom, and see how this ties up. We'll make this a 10-day RSI. There we go, 10-day RSI. What's been interesting in dollar yen is what a great job this year's highs have done in capping any progress. Okay, and I think it's also actually it's a good lesson in being patient as well. So we had this rally in dollar yen from down here, from around 107, and that was in September. So the market rallies from 107, rallies up above 114. So we see a 700-point rally in dollar yen from September. But look what's happened. The last week of October, first couple of weeks of November, once again, sort of 114.40 to 115.60 has proved to be too big a barrier. So again, any rallies up to these sort of obstacles look like a selling opportunity, and it's taken a while to happen, but it has, started to roll over. So so if it was above 114, and we had plenty of opportunities during the day, this period here, when it did trade above 114, was a good opportunity to go short with maybe stops above this, the ultimate resistance from way back here in January of this year, and the market has dropped a couple of 100 points so far. For fans of the squiggles, we talk about this a little bit, and I'm sure we'll do it again in the future. We did have, confirming a sort of maybe a sell signal, we did have this idea of bearish divergence. So the market hit a high, traded higher. So looking at just the price action, it looks like a good trend, but our RSI was making lower highs. So this is bearish divergence. I suppose at the moment, it's another interesting one at the moment because, markets don't move in a straight line. Dollar yen has sold off, but if you wanted to be a little bit of a contrarian, there's an argument for being a buyer down here. Maybe we think it's going to have yet another go at those highs from here and the highs from back at the beginning of the year. So I think this is an interesting one to watch. 114.47. Let's flick this over to the hourlies and just have a quick look at that, see what that looks like. Here we go. So so these are the lows from back here. Oh, actually no, that's the wrong lows. Sorry, ignore what I'm talking about there. So we're looking at the lows really from around about. Right. Well, I suppose that is those lows, isn't it? 111.60. 111.60 is the low. I really should try and think straight. So the old lows back here from the middle of October, the market hit 111.60 and then rallied 300 points or so. The market's dropped 220 points and we're back down here. So again, I think on dollar yen, if you really wanted to trade it, and I think this is from the examples we looked at, the euro and the pound, I think this is maybe the best potential trade we've seen so far today. There's our level, so we're going to go stops below 111.65, which I think gives us potentially 2 bites of the cherry, because if this thing is going to turn around, it really shouldn't be taking out the lows from November the 19th. So let's just stack this trade up. So the market's slid. We've hit a level. We've rallied. 5 hours ago, it came back to the level and it's rallied. Now this is where our little price action bit comes into today. So we're trading using price action, and the whole idea about trading using price action is we ignore the squiggles down here. So we're trying to trade off what the price is telling us. Now, back here, the price was telling us, November the 19th, okay, maybe 112 is a bit cheap, and the buyers come back in. Okay, so if we were looking at it there, we could deduce that 112 was pretty cheap, but the market's already rallied. Okay, but that's our price action move there. But the more important price action bit is what's going on now. The market's come back down again, and it's rallied. So again, it's a suggestion. Well, maybe it is a little bit too cheap down here. So we have the price action. We'll see a good example in the DAX in a minute. We have the price action suggesting that maybe the slide for now is overdone. So for the fans of the squiggles, we also have an oversold RSI down here as well. So a couple of things there suggesting maybe that's not a bad trade to do. So we could be a buyer at 112.13. Stop loss. Now, an aggressive stop loss would be under there. I might go for a stop loss down here. So 111.50, let's say on a stop. So we're a buyer at 13, stop at 50, 63 points risk. And if we think it's going to go all the way back, if we think it's going to squeeze its way back up to 114.60, we've got 240 points upside. So 60 points risk, 240 points upside. That looks like a good trade. You've got 4-to-1 risk rewards. But again, maybe it would be, I don't know, would it be a bit reluctant to trade ahead of the Fed? Probably, because it could just spike through that level. But I think it's really interesting dollar yen, it's interesting from the bigger picture point of view, because yet again, we've seen those highs stop the rally. And it's interesting from the short-term point of view, because we're seeing a little bit of buying come down here ahead of what has been a big level. So I think dollar yen's maybe an interesting one to watch the next couple of days, maybe once we get this shenanigans out of the way this evening. We'll have a look at indices now, but just on this topic of price action, it's letting the price tell you what you should do rather than letting an indicator tell you what you should do. You know, if you've been on these webinars before, you'll know I'm not a massive fan of indicators. I think the problem is in the beginning when we first start trading, we all think, well, I did anyway, oh, the answer is in an indicator. If I can just get the right settings for my stochastics or my RSI or my moving averages or my MACDs, then untold wealth awaits me. The reality, of course, is that it's complete rubbish. All indicators are, like the RSI down here, it takes the price data, applies a mathematical formula to it, crunches it around a bit, and bang, spits out a squiggly line at the bottom of the chart. So it's all derived from the price. So really, where we should start, and arguably where we should stop, is what the price is doing. Yeah. So price action is we're letting the price tell us what's going on. So what's interesting with this DAX, I think we were looking at this a week ago. So the DAX hit fresh all-time highs. This is the German 30, fresh all-time highs at 13,500, whenever that was, beginning of November. And fell off a cliff, or fell 700 points, so about a 5% drop. But what we've seen happen over the last week is a longer version of what we just looked at in dollar yen, where the DAX is in an uptrend. So any weakness should be viewed as a buying opportunity. It's just where you get in. But what's interesting is, look what happened here. So the 15th of November, so a week ago when we were doing this webinar, the market traded down to wherever it was, 12,846-ish. The market rallies, and then on the 20th of November, which would have been Monday, the market trades back down again and bounces. Okay, so this was our sort of price action buy, hitting the same level, and the market moves away. Let's take a look on an hourly, so we can see that. Let's see how quick that actually happened. I don't actually know how quick that happened, so oh, we had plenty of time actually looking at that. So the market had, let's plonk some lines on. So there's our first one from the webinar. I'm sure this was, I think I did talk about it in the webinar last week. So we hit the level, 12,848-ish last week. The market rallies, whatever that is, a couple hundred points nearly? Yeah, a couple hundred points, and a bit more. So the market rallies 240 points. Comes back down to it, and I would suggest, it depends how conservative you want to be. Personally, if I was watching this, I would probably have got in here. Okay, well, we'd seen the price come down. These are hourly candles we're looking at. We have an hour where the price stops going down. So maybe we buy at the start of the next candle with a stop loss underneath the low. So we would have bought, if we'd have bought in, we'd have buying at, let's say 12,910. Market pushes a bit higher, but then dumps again down to those lows. So we're thinking, oh, we're going to get stopped out. But once again, it holds. And then bang, we are where we are now. So that's an example, I think, of using price action to trade. So for me now at the moment, the market has pushed out through these old highs here, pushed out through these old highs here, pushed out through these old highs back here. This is all short-term stuff, and sold. So I'd be a buyer. I'd be looking to be a buyer, and it's all about now. Well, where would you have your stop? An aggressive trade, if you really wanted to buy it now, at 13,164-ish, will be a stop under the lows of today. So the other side of 13,100. And maybe a slightly more relaxed trade is underneath yesterday's lows. But clearly, this 12,848 level is big support that's been left back here. Let's just take a look on the dailies, just to see where we are. Why is my chart going all funny? Here we go. So I mean, the DAX is probably the more volatile of all the indices that we look at, but it's in a definite uptrend. If we just go from June 2016, our uptrend looks something like that. I'm assuming that's US election spike. So there's our uptrend on the DAX. Let's just zoom that out so we get the whole thing in. So the market would need to drop about 1,000 points from where it is now to threaten that uptrend. And for me, it's only if we lose these old supports at 11,850. So from a medium longer term perspective, the long-term trend for the DAX is still most definitely up. And from a short-term perspective, we saw some of the levels there. Let's take a look at just the most boring market in the world, because it always goes up, the S&P 500. So this is the broader US stock market index. I know I say this every week, but yet again, yesterday, the S&P hit fresh all-time highs. It refuses to die, the S&P. It gets knocked back for a couple of days, and then bang, off we go again. I mean, it really is quite incredible. You know, from a year ago, before the election, day before the election, the market closed at 2146, and today it's 2600. So it's moved, what's that, 450 points ish in a year. 450 points in a year. So it's more than 20%, isn't it? Maybe getting on for 25% at the moment. And I looked again before we came on. You know, some brokers publish data about are their clients long or short, and it won't surprise you to hear that with another broker, 75% of their clients who have trades on the S&P are short. Yeah, people just cannot buy stuff that's going up, you know, and we just have this market that it is incredible. You know, it gets knocked back down. We had these old supports, and it did blip down, but again, it really big support on the hourly chart. I think we were looking at these last week, around about 25.65, and it sort of blips through. Yeah, we were looking at it here, and it blipped through on the open, but it spends an hour below it, and away we go. Away we go again. You know, comes back down towards the old support earlier this week, and then it's just flown again, and it's just gone smashing through these old highs. You know, so you'd have to be, again, we don't have to be, but you know, for me, you've got to be a buyer. You know, in a trend that is as strong as this, you have to be a buyer. It is, I think it's hard to trade. I think if you, I'm glad I don't sit there and try and trade it throughout the day, because I think if you was trying to sit there and call all the little turns throughout the day, it'd be really frustrating, because it just seems to have these days where it just takes off, and then days where it doesn't do very much, and then you're either in when it takes off or you're not. So fresh all-time highs on the S&P through 2600. You could argue a bit of a psychological level. Where does it go next? Pick a number out of the air. You know, it's gone from 2500 when it sort of started breaking 2500 back here September. So 2 months, it's done 100 points. So 2700 by the end of the year. Who knows? Who knows what's going to go on? But an incredibly strong market. And once again, if we plonk our trend line on this from maybe here. Oh, if I could draw it properly, which I can't. You know, it's only if the S&P drops back below, let's say 2500 for sake of argument, that this trend post the election starts to look under threat. So it is still an incredibly strong market that defies gravity. But I would not bet against it. There's a lot of, actually look at that, there's a lot of bearish divergence, but it doesn't care. It's the S&P, it doesn't care. The market's hit a high, this is on the 10-day RSI, so the market hits a high. RSI is overbought. Market pushes a bit higher again. RSI is overbought, but it's got a lower high. Market is pushed out to fresh all-time highs. The RSI is diverging again, lower highs. That's massively bearish. That is, you don't very often see, I don't think, triple divergence. So it's got to go down now, obviously. But that'd be interesting. Maybe in 3 weeks' time, if it's crashed, I'll go back and say, look, we totally called it with the RSI. But that's a really bearish sign. But the market doesn't care. It just keeps going up. So there's the S&P. Still strong, and still going up. The FTSE's been an odd one. I've got a few, I'm sort of like most people, I've got a few UK shares in ISAs and stuff, and they're really boring. I should just buy an S&P tracker and be done with it, because they're really not moving that much. Here's the FTSE. So the FTSE has woken up a little bit, but the FTSE is still well capped by these old all-time highs at 7,600. You know, we've had a look at it throughout October and again in November, and they just can't break it. It sold off again. You know, we've sold off, found a bit of support, and maybe it's gearing up for another break. But it's a serious laggard, the FTSE. Clearly, the pound. You know, we all know the pound plays a big part in the FTSE. If the pound's strong, and the pound has been strong, you know, for the last few months or so, it weighs on earnings, because so many FTSE 100 companies derive their money from overseas. So it depresses their earnings, a stronger pound. So that can weigh on the FTSE. But maybe, you know, we need to break 7,600. If it breaks 7,600, that should be the catalyst for the next trend higher. But it's really, really struggling to do it. You know, it's really not doing it. So yeah, there you go. Boring. Trade the S&P, much more interesting. We'll have a look at gold. Is interesting. We'll look at gold in a minute, and oil, of course, is interesting as well. But let's do Bitcoin. You know, the S&P is crazy, but but Bitcoin takes craziness to a whole new level. I think I've said in the past, I have been buying in a bit on Bitcoin, even though I think it is a ludicrous market and it's a bubble and all of that. You know, I've been buying the breakouts, but I do have a really I've got a stop on everything underneath yesterday's low. And then if I get stopped out and it breaks out again, I'll start buying again. But it's, you know, it's just a crazy market. 2 weeks ago, there was this news that the hard fork, whatever that is, and I don't care about all the techie rubbish, the hard fork wasn't going to happen. Bitcoin breaks out to fresh all-time highs at about 79.50. Then over the next 4 days, falls off a cliff back to sort of 5,500. And then last week, goes all the way back up and sets fresh all-time highs. So it drops 30% over 4 days, then rallies 50% over the next 4 days. It is a lunatic market. Okay, but you can't argue with the strength. But I really do think if ever there's an example of the greater fool theory going on in markets, it is Bitcoin. You know, which I'm just buying under the assumption that there'll be some other idiot who's going to pay more for it in 2 weeks' time, you know, and suck the price higher. But it is it's incredible story of what's happened this year. You know, it's gone from what, about 1,000 to where we are now, 8,300. And it's still strong, but it is one of those markets where I think you could wake up one day and it's halved, or it's worth a tenth of what it was the day before. Absolutely crazy market, but still very strong and setting fresh all-time highs. Let's get back. Let's put our feet back on the ground. Let's look at gold. This has been interesting. It's been a bit volatile the last couple of days, but I think the view from my view, I think for most of this year and from the last week, you know, still holds. I think it's still bullish. You know, we've seen it's been a real messy one in terms of trend lines this year, gold. You know, we've had trend lines that look like that and then get broken, and then the price doesn't go anywhere. Then the price pushes a bit higher. So we have a trend line, arguably, that now looks like that. And we are within that trend. You know, we've got higher highs, higher lows, big levels hold. We've looked at this level before where the correction from the highs from the year, about 1360, pushed it down to 1260. Market rallied, breaks out the downtrend, comes back again, a price action thing, comes back down to test those old lows down here, 1260, and it's held. You know, so for me, while it's above, well, the trend line for a start, and these lows running from, I don't know, even as deep as here, 1245 to 1260, you know, I'd expect the price to go up $80 rather than go down $80. You know, so I think it's still pretty well supported. It's maybe been a bit of a quiet couple of months for the price of gold, but still well underpinned by the 1260 support. And I'd expect it to squeeze higher back up to the highs, maybe not before Christmas. Yeah, that's the level to watch. I think this most recent support. And finally, the price of oil. I don't think I've got it in my watch list. I had a little bit, hang on, is it there? Yeah, there it is. Like we were saying, or like I was saying a week ago, you know, that trend is strong. You know, you really at the moment don't want to bet against the price of oil. You know, I was surprised. I thought at the beginning of this year, we were going to see a push out to the mid-60s, but it really rolled over beginning of the year. And the story for the first 6 months was of a downtrend. You know, we had this succession of lower highs, lower lows, blah blah blah, and the market just traded lower. But we had this breakout in September, and that trend has continued, and we're almost setting fresh highs for the year. We did set them just over a week ago. And I think you've got to be bullish on oil, you know, or definitely not bet against it. I think, you know, maybe it is a bit overextended. We can see that from the RSI. Very overbought here, hasn't really pulled back. If we've got a deeper pullback down to the low 50s, it looks like a buying opportunity. But at the moment, the fact that, you know, a couple of things. The fact that it's broken out through the highs, the original highs for the year, just above $56 a barrel, that is positive. And this trend from June is still positive as well, you know. So I think for oil, any weakness continues to look like something of a buying opportunity. Let's take a quick look on the hourlies, and we'll wrap things up. So it is a funny old market, oil, but you know, you have days where it's just incredibly quiet like this. So it trades from 55 to nearly 56. So a 100-point range, a dollar range over a couple of days, and then bang, you know, off it goes. But again, I think it does give you, you know, good obvious levels for setting stop losses. You know, it sort of hits a low, rallies a bit, comes back. So if you're buying into the trend and you want tight stop losses, there are often places on the chart where it spends a little bit of time faffing about giving you an obvious level for a stop, but the expectations would be, I think, definitely up to the end of the year, you know, for the market to squeeze higher, the price of oil to squeeze higher. So there we go. It's a bit, like I say, it's a bit of a strange week. We've got the Fed minutes this evening, so a quiet afternoon probably ahead of that. US markets are shut tomorrow, so maybe a quiet day tomorrow, half a day for markets on Friday. Basically, I think we should just all start our Christmas shopping and come back to it on Monday, when hopefully things are a bit more back to normal. But for this week, we'll start wrapping it up there. As usual, if you have any questions, drop me an email. My email address is david@tradeafter.com. You can follow me on Twitter for occasional charts and stuff. I'm @JonesTheMarkets on Twitter. And to find out more about this idea of copy trading, I've blogged a bit about it, which is well overdue an update, but I won't do it till next year. But there's quite a few blog posts on my website, which is tradeafter.com. But for this week, we'll wrap things up there. Thanks for coming along, and we'll do it all again the same time next week, but it should be, I think, a bit more exciting than it has been this week. Thanks.